Welcome to StockOdds episode Odds and Ends with Dave Singh and Rob Friesen. Good evening, Rob. How's everything?
Not too bad. Your voice is slowly improving over last week.
Slowly
here.
Improving. Yeah. Maybe by next week.
I guess you weren't at the Super Bowl there shouting and yelling, and it's so you saved your voice, eh?
Yeah.
So, what do you think about the game? Did you see it?
I did. I was out playing tennis and I had a barbecue with the family, so I was more socializing than that.
That's better for you than just cheering for somebody on the telly, anyway.
Did you watch it?
Yeah, I did. Yes. So we've got this Super Bowl indicator that they've talked about for years, and so you want to hear about it?
Yeah. What is it? The next day is bullish? I mean,
well, if the NFC wins, then yeah, it's supposed to be more of a bull market, and if it AFC would have won, then there would be more of a bear market. But it's not, it's not a guarantee. It's just a well, as they say, like just because something happens doesn't necessarily mean there's a fundamental reason for it. So it's been I think right 70-something% of the time, but it doesn't mean
those are good odds.
So we got plenty of obstacles in this marketplace, but we certainly could have a bullish year. But lots of things going on the macro front, of course. So someone was speculating before that, well, if Putin's going to invade Ukraine, he's going to do it during the Super Bowl when we're all distracted. Well, that didn't happen. So anyhow, let's see.
We had a big
kick it off.
Friday we had a big sell-off. Yeah, Friday we had a big sell-off. Kind of this paranoia about imminent war. And the futures are kind of quiet right now. They're just kind of muted there, slightly up. And oil's slightly up too, right? Geopolitical risk. But we're also headed to mid-month seasonality, which is kind of bullish to begin with. So I did a little bit of work here on the mid-month seasonality sectors, but the futures aren't doing much.
Listen, I mean, the thing is this, is that, I have no problem allowing, some probability of a Ukraine invasion. Okay. But what I don't like is I don't like the spin doctors. I don't like the media. I think if we have a virus in the world, it's mainstream media. That's what it is. No, I'm serious. Because it's dollar driven and we've lost our sense of balance in that arena, and it seems to be largely one-sided in many aspects, and it seems to be utilized by politicians. Like, for example, in Canada, the politicians own the media. It's plain and simple. That's the same thing in China and other places. The media is state-driven, right? So you don't really have a fair and balanced approach. So if there is a virus in the world, it's mainstream media. I'll say that again and again and again. And it's not healthy for your financial, success. You can listen to it to sort of be a critical thinker and read in between the lines and extract things, but you can't be influenced by it. Okay? So it's water off a duck's back for the most part is how you have to treat it. But there are some things obviously to pay attention to. So, I mean, we have, in finance, we have different events, we have seasonality, we have earnings, things like that. So, these things can drive things and yeah, they may be reported by the media, but the thing is they may not report it accurately. They may do, the shock jock thing, the headline thing. That may not be the whole story. So, like, even if there's legitimate things to be reported, doesn't mean it's reported correctly. Okay. So, coming on to the earnings calendar this week, what do we see here? On Monday, not too many big companies of significance here. let's get into Tuesday and just take a look. We got Alibaba. We have Airbnb, right? Marriott, Viacom. So starting to get some more, more significant names. Going into Wednesday, we have NVIDIA. That's a big one. That's after the market on Wednesday. Cisco's also after the market on Wednesday. AMAT, Shopify before the market on Wednesday. Analog Devices, ADI, before the market. By the way, the merger between AMD and Xilinx was approved. It should clear by Monday on the close. Consummation of the merger. And it just a reminder, like a lot of people were, buying and selling AMD as if it wasn't in a merger. I was always surprised by that, treating it the same as if, it wasn't involved in a merger. And merger stocks are different in the sense that they have, the market could be rallying, and normally those stocks might be correlated to the market, but they're going the opposite way. Why are they going the opposite way? It could be completely related to the spread, could be completely related to money flow because of another reason, right? Because of the merger. We have Baidu, we have, so Hilton also, so we got Trade Desk, VMC. Okay, so that's Wednesday. Let's go to Thursday here. Thursday, we have Walmart, Southern, Dollar Tree, or no, sorry, not Dollar Tree, Digital Reality Trust, Roku, Dropbox. Anyways, and then Friday.
I think the Walmart one could be pretty good. I mean,
yeah, Friday we got Deere, we got DraftKings, we have that's about it for the big names. So anywho, what do you see on the seasonality side of things?
Yeah, so mid-month, it's kind of a riskier, high beta kind of plays. So I see things like biotech, the IBB, the ARK funds, ARK-K, the SMH chips, financials. So and even retail, XRT. So these are kind of risk on cyclical kinds of ETFs that are popping up as strong for the mid-month seasonality.
Did you check Friday expiration at all? Because this week is mid-month seasonality for the entire week, culminating in Friday's expiration, right?
And I just pulled that one up too. So that one also has XBI, which is biotech, and IBB, and also some financials, KRE, and IWM too. So it's for the mid-month seasonality and the third Friday. Some of the sectors seem to line up, and it's kind of a risk-on, high beta growth year kind of companies.
Right. Okay. We are
coming in quite discounted. So Friday we had such a sell-off there into the close. So we are coming from a discounted perspective. So that coupled with the kind of backdrop for a risk on mid-month, we might get more bang out of this week than normal.
Okay. There was some information about the inflows into global equities. We've had tremendous inflows. You think of only the sell-off, but global equities have logged 152 billion worth of inflows just year to date. So I think people came in to pick up some of this discount that we've seen. And again, that could play into the argument of, we're not going to see much downside. So there's a real tension here between, we've got the Russia and the Ukraine thing. We've got, the Taiwan thing. We have kind of this case for potential inflation just causing more of a recession, and even some are coming out of the woodwork and saying depression. And so, I mean, I think you can pick out, like I was thinking about this when people are afraid of things, if you're really afraid of things, you can pick out certain arguments to substantiate that fear, to back that fear, right?
Mhm. Yeah.
You can source things that complement that and feed into that. And if you're optimistic, you can also do the same thing. You can find things that complement that. So we really have this divided situation in the market, and it could just continue to give us that volatility. I don't see it subsiding that much. I think we'll probably stay between 18 and 28 or something, and bouncing around in there for a little while yet. We still got to get through the finale of earnings season here. But it's just interesting. So if we don't have any major drumbeat on the macro side for this week, then I would stick with the seasonality. I would look for a little bit of follow through to what we started to see in terms of a bounce, and then of course that was interrupted with the drumbeat of war. But like I said, the media loves to hype up things and make them larger than life. So there may not be any invasion imminently, as we saw on Friday. That was the talking points that kind of knocked the market down. But yeah, I mean, I wouldn't hang my hat on it. Let's look at the futures here. So when we opened, we were kind of sideways a little bit, and we've risen in the Dow futures. We're up 0.18. S&P futures up 0.20. NASDAQ up 0.18. And the Russell up 0.49. Russell, again, still the one that has the biggest journey back to where it came from versus the others. And the one that seems to be, just looking like it's more resilient is still the Dow overall. And the NASDAQ is crazy. Like, when we get a rally day, we can be up 2.5%, 3.5%. When we get a sell-off day, we can be down 2.5% or 3.5%. Those are big moves with the tech stocks. I mean, that's nothing to, like, if you put a spread relationship on, let's say long the NASDAQ 100, so long the Qs, and short the diamonds for the Dow 30. And you're wrong, you can get run over pretty good, even in just putting that spread on. So, it's no slouch. Looking at the map of the market, Friday, we saw right across the board, the technology stocks down, a little bit of green spots in some of the pharmaceuticals, even drug makers specifically. Aerospace and defense was obviously green on Friday. We had tobacco, packaged goods, some of the staples were green. Energy was quite green across the board. Some utilities were green. So that was the landscape on Friday by the close. And what's remarkable to me is this whole thing of energy. I just got to rattle this off. Look, so the 1 year performance, 49.89%, right? Half year, 34.71. 3 months, 18.17. 1 month, 8.67. 1 week, 3.23. Or actually 2.23. And then just for the 1 day on Friday, again, 2.72. So it's remarkable that energy, and I just don't really see a great argument to sort of step in front of that until it really changes. So, I just don't want to wrestle with it. You know what I mean? Like you could even have it looking weak in the morning, and so you jump on it, and then by the afternoon you get run over again, right? So it's like, take the group out if you want, if you don't want to play around. And then the technology has been one of the weaker sectors over that same period of the 3 months, the 1 month, and the 1 week, and then on Friday as well. So again, picking sectors that are more forgiving, you're probably going to be doing a little bit better in sort of the healthcare area, the industrials, some financials, and maybe some consumer cyclical and some consumer staples or consumer defensive. Those are going to be a little bit more forgiving, have longs and shorts in both. And then you really don't have to mess with this, getting in front of a freight train.
Mm-hmm.
Does that make sense? I mean, if you want to be long, short, diversified, no real opinion, not having to make huge discretionary decisions, that's what I would do. Is pick the middle performers. Don't go after the extremes, because you could be either super right or super wrong.
Yeah, energy is going to either make or break your basket on the day. So,
well, it could depends. Like if you just go and curate a bunch of stocks and then you don't take a look at them, you might find, because of the massive performance that they had on Friday, that they actually could be argued on a statistical basis to be pulling back for Monday. But that might not be the case. We're still so strong on the macro side that there has to be something that really comes along and interferes with that, like world peace, right? Like what the Beatles sung about. Okay, if we get world peace, right, then maybe energy will go back down.
Mm-hmm.
How about nuclear fusion?
Yeah, I heard about progress in that this last
week. Yeah, maybe oil will go back down, right?
And the price of energy will go to zero, unlimited forever.
I would listen. There's going to be, this is the thing you have to remember as a trader, is that you got your whole life ahead of you. You have a whole career ahead of you. If you can be patient to when things really change on a macro basis, and then you'll have literally 6 months to a year potentially of being able to work that from the short side statistically from StockOdds over and over and over and over again. But if you waste all your money trying to fight something that the macro is overriding the statistical, right? Something is overriding the noise. It's overriding the normal signals and statistics that you would depend on, right? Then it's a fight that you don't need to have. Your money's better placed in other things that don't have that same macro force. Like in healthcare, you're going to have stocks like, some of the stocks that were up on Friday in healthcare were down on Thursday. We're up on Wednesday. We're down on Tuesday. We're up on Monday. Do you follow what I'm saying?
Yeah.
Okay. But in energy, there's just too many of them continuing to fire on all cylinders, and it can be a big fight. So same thing with some of these stocks that, just don't have earnings or way too expensive. There may still, in the technology space, there still may be a correction there to occur yet. So anyway, let's run with the sort of seasonal backdrop. Let's be more of stock pickers, I think, when we look at, with this whole inflation argument, it's forcing people to be more stock pickers, to think more about. It's not like you have a rising tide lifts all boats. You're going to have winners and losers in this whole, 2022 of, pipeline bottlenecks, inflation, all kinds of things. So you have to be a little bit more research driven and, pick your battles. Okay. Just remember some of the earnings this week still, like NVIDIA can be, if you have NVIDIA in your basket going into Wednesday or whatever, you don't have to be in front of that if you don't want, right? You can let it play out. Okay.
Good.
What else we got? Anything?
Well, I was looking at the IWM, so the Russell stocks. Those are expected to vastly outperform the Spider. So for mid-month seasonality, IWM is 1.68 expected return versus 1.17 for the Spider. And same thing for the third Friday of the month. 0.5 for the IWM and only 0.06 for the Spider. So in both cases, it's up almost 0.5% over the Spider, the IWM. So having the stats that you're back with those, maybe pressing some of the small cap Russell stuff might be good this week.
Well, yeah, I mean, I always like to, they say that chance favors the prepared mind. So I always like to have a few things curated in the small cap area, even if I'm just playing around in the S&P 500. And the reason for that is if you have that wish list of things that you might want to pick up, if we come into tomorrow morning and things are still pretty good and, maybe the Super Bowl indicator works this time, whatever, everybody's like, frothy. If we come in and it looks like risk on, then I have no problem deploying that. And if you do it in a metered approach, even if it went wrong, it's not going to be a deal breaker. If you went all in on just small caps and they happen to reverse, then it's going to be a problem.
Uh-huh.
Right?
Yes.
So don't be afraid to have a bit of a wish list. Like, I think people sometimes stumble on this. You think that everything that you research has to be implemented. Well, what other businesses are like that? I mean, not everything that you come up with, not everything you brainstorm, not everything you plan is going to work out. So why can't trading be, you do a bunch of homework, you have a bunch of different lists, you have some ideas, and you come in the next day and you could throw it all out and not do any of it, right? Or you could do all of it. But what's the harm in being more prepared? Right?
People get married to their research. It's like,
well, I mean,
that's 4 hours.
That's exactly it, is that they marry their research. They think the ideas that they've come up with have to be implemented. No, they don't. Things can change in the next, 8 hours. We don't know what's going to happen. So we come in and we implement according to what the market's giving us. We have to listen to it. It's the master, we just follow along. I don't tell the market what to do. I listen to what it's telling me to do. So when I come in tomorrow, if it looks like it's a bit more risk on, then I'm happy to implement, the different aspects of the research that I've done. And it may not be all of it. I mean, I might do this. I might just go, I'm only doing my long side and I'm only using the diamonds for a hedge. I might be that confident. Or I might say, no, I have to implement longs and shorts balanced because, I don't want too much of the ETFs. I want to have like my longs and shorts working for me. I might come in and say, I'm going to do some small caps along with my large caps. I might come in and say, I'm just going to play in the NASDAQ 100. I'm going to short the higher PE multiple stocks and buy the lower PE multiple stocks only in the NASDAQ 100. That I might do. I don't know yet. But opportunity and chance favors the prepared mind. Okay?
That's a good thought to end on. Good.
All right, my friend. Have a good night and catch you in the morning.
Thanks. Good luck.